Despite a lot of movement, the S&P really went nowhere. 4190, we're still fighting that 42 elusive level. We're going to talk really about AI and what's happening after hours with some of these software companies. And we're really going to talk about them technically so that people can understand this. I also want to discuss the lack of breadth and what we're going to do about it, how we should be playing it. But when we look at the Nasdaq, I'm just going to use the futures market here, you're going to notice a couple things. Number one, you have not come anywhere near down to any kind of real test yet. The only thing you've done is have 2 days where you've gone down. You could come down 3.5%, and that would just be a test of the neckline that we just broke. That's all that would be. It should not really be shocking to everybody, especially those that listened last night, that this is a doji, and when we broke below that doji, that was pretty much it. And that's exactly what we want to see, actually. Now, just for point of reference, when you have something like this, see this big green bar here? You didn't even come down halfway to that bar. So let me show you what I mean by that. So if we click here and we click on fib levels, we just put these right here and just leave them on there. Clean it up, and then we're going to leave 50. Now, I know 50 is not a fib level before you comment below. Fully aware 50 is not a fib level. But what you're going to notice is I just use it as a demarcation line, meaning this is the breakout bar, and we haven't even come down 50% of that bar. So how bad was this sell-off? Well, it was focused on a couple names, and we're going to address those names. But first, let's go through some key levels. I'm just going to note a pattern. Anytime that you're above this 70, you're going to see us kind of revert. I'm going to give you a couple examples. But if we mark like the uber high level, which is right around this 88, we can see this pretty clearly, right? 1, 2, 3, 4, 5, 6, 7. So you have about 7 times right here that you're touching this, and it gets pretty obvious what happens around those times, right? You're just going to spike up, and then you're going to kind of go sideways. Maybe you're going to go up again, maybe you're not. You don't really know, right? And then here we are again. So this is not rocket science. We should not be shocked that the RSI is doing this, right? So at the end of the day, we have these levels, we know where we're at, and we know that we were over here. And this is why even on Saturday's video, we went over this. And we're very clear, like, look, it doesn't mean anything if we pull back. It just means that we're pulling back. Now, key levels that I would look at if I was you is I would start looking at these trend lines to start. So I would start wondering, are we going to get down to this trend line? And then that's going to be able and have us mark off other areas. Okay, so now we're at that 14. Are we going to get to 14? Now, mind you, if I told you a month ago, oh, we're going to be fighting the 14 level, you would have looked at me like I was crazy. So we came a long way in a short period of time, and you have these minor resistance here, 13.5, 13.343. You're going to want to remember those levels. But if you come here and just kind of take a look and go, okay, well, here's a major one, this 13, right? You start looking at these levels, you have nothing but support the whole way down. Now, the entire time we're doing this, just notice the fact that we did pop over right here. Let's blow this up so we can really get into this. You can notice that you did pop over and you've already worked it off. So then if we go, okay, well, we've already worked it off, is that something that we should be looking at, right? Because we always want to look at both sides of the coin. The goal is to get the most objective information that we possibly can get and then make the most informed decision that we can make, right? That's what we're trying to do here. So if you start looking about, okay, well, when we're under this level, yep, sometimes that puts in a bottom. Sometimes you might have to go through that double bottom process and that positive RSI, right, divergence. But you start just kind of clicking around here and going, well, yeah, that pretty much did kind of mark the bottom of these, didn't it? And so just by doing something as simplistic as this, and listen to when I say this, on an hourly chart, your life will get a little easier, right? Well, that one doesn't really look that groovy. Well, I guess you're kind of here. You can kind of see that divergence from down here. Let me just see where I'm at. Yep. So you're not really here on it. Maybe on that loose last part right here, you probably are. Let's take a look at this and see if we are or we're not. Yep, if I drop a pin right there, you can say it. That takes us right there. So it takes us right to where I thought it might, but I thought it might have been a divergence. Doesn't matter. No, here we are. Are we that much lower? No. But we had some earnings tonight. Maybe they'll take us lower. I actually think somebody had a margin call today. I'll explain why I think that. But we need to get into a couple things about this breadth and how silly this argument is. Now, the majority of people use breadth and they state new highs, new lows. That's what we're going to do. We're going to use the New York Stock Exchange. And we're just going to start with the very basics. You can see how we are red here, these huge spike ups. right? So you're seeing huge buying. Everything's green. Look at the breadth. Look how beautiful that is. How did that work out for us? Not very well, okay? Huge breadth spikes actually mark levels where you want to sell into. If everything is going up and everything is hitting a new high, there's nothing left to move. The reason we're going back to '03 is because before this in '01, what did we have? And in 2000, what did we have? Tons of IPOs of companies that never should have been public. What do we have now? Tons of companies that never should have been public. Okay, so we have a very similar situation, but if we grow here and take a look at this, there's one pattern that always stands out with every single bottom, every single one. Okay, number one, you come right here and you have a low, then your next new lows is not as bad. Okay, every single time that you put in a major bottom, whether it's here, whether it is the great financial crisis, you can see us right here. We made a new low, and at the same time, we didn't have the lower lows. But where's all my breath? Where's all my new highs? Well, this was all garbage that went public for 2 years. So now all the garbage has to clean out before you start to see that breadth pick up. And I'll show you a much easier way to measure breadth and what's going on out there. Now, the pandemic is the pandemic, and there's not much I can do about that, right? So what do I mean by that? Meaning it's an anomaly. This is how stock market's going to act during a pandemic. We now all know that. What I can do is I can point out this bottom of October, which I have been saying has been the bottom for some time if you've been following along. Let me just show you what I want to show you so that you can say it. What do you have here? Okay, you have new lows, exhausted. What do you have over here? Less new lows. What is the argument that we keep hearing? The argument we keep hearing is, well, there's no new high, so the breadth is bad. Now, there are things to really be concerned about that we're going to address. There are issues out there that I see that we will address. Breadth is not one of them. You need to work it off. You need to work out what never should have been a SPAC, what never should have been public, what never should have been out there at those prices. That's all excess. It has to work off. This is a symbol that you can use. TradingView and other systems will have it too, and you can use it on TradingView for free. NDTH. Nasdaq 100 stocks, meaning stocks that are good enough to be in the Nasdaq 100, the largest, biggest tech names out there. You have some other diversification in there, biotech, some other fields. Okay, 1 week. Okay, so we're looking at the weekly. Okay, you're at 66.3% of all stocks are above the 200-day moving average. That seems pretty bullish to me. Okay, so as far as breadth, 66% of all stocks that are in the Nasdaq 100 are above their 200-day moving average. Okay, I don't know how much more people really want to see. And if you really want to get into the nitty gritty of this and you look at this, and we've been talking about this since October, but if you really want to get into this level, there's a real clear level here that once we hit, it really seems like that's it, doesn't it? Right? So here we are during the pandemic, then we're down here. And why is this bad? Because this is true, to me, this is how I view true breadth. These are real companies. Okay, these SPACs that everyone bought that were going to create a new kind of jello that everybody was going to eat or whatever the heck they were going to do, right? Every EV that went public, they never should have been public. And they found a real cheap way to do it, and they destroyed people, and they still are to this day. What I'm getting at is, at the end of the day, you have a bunch of stuff out there that never should have been public. Start using this as a guide. Now, you can also use this as a guide, S5TH. Now, this is going to be the S&P and stocks above the 200-day moving average. I said earlier that there are things that are concerning to me. This is one of them. I really don't like when we are not above 50. I would prefer to be above 50, and I'll show you why. So if this is helpful, just comment below. But I really think people need to understand this in this breadth argument. And I'm going to get into another part of it that people are they're just completely missing. If you take a look at the 50 level, right, and the demarcation line, and let me mark that line off first, and then we'll go from there, put that back in. So here's your demarcation line right here, right? There's your 50. We can go from there, just drop that in, pull this back, and then we're just going to hit that SPY again. All right, great. So there's your demarcation line. Every time you get over that 50, the market goes higher. Every single time you get over that 50, the market goes higher. Every time you drop under that 50, the market underperforms. It might not collapse, but the market goes lower. Okay, so if you're using this as a demarcation line, okay, if you're using this as a demarcation line, it is pretty darn clear as to when you should be looking to get in and when you should not be looking to get into the S&P, not the Nasdaq. And this is what it's showing you. And I think it's very clear. So these are the two ways that I would measure the health of the market, or as how people refer to it, the breadth. If you go back and you look at the amount of garbage that came out in 2000 and 2020, it's going to weigh on those breadth indicators. Now, what is going to drive the market is technologies. It's not going to be basic materials. It's not going to be the energy market. It's always innovation, which is always technology. Could be biotech, and that's happened in the past. This is Intel 1998. Just want to show you this. So here you are, right, chugging along. And guess what we're all buying during this period of time from 98 to 99? We are buying three names. We are buying Intel, we are buying Microsoft, and we are buying Dell Computers. Microsoft is the operating system, Intel is the chip, Dell Computers is the box. Then along as time goes on, more companies start going public. As more companies start going public over the course of that year, this is what happens. And then we get the inevitable, too many companies went public, the absolute implosion of the market, and then came down. Now, why am I showing you this? This is Nvidia. This is week one of being over this high from 2022. And we have people already calling an end to the AI mad rush. Okay, you're barely in the first inning of this. Right, Goldman had a statement out today, and I will put it on Twitter, and I'll start showing these comments if they're helpful. Let me know in the comments if you want to start seeing them. Goldman had a comment out today in their research. In the next 10 years, $7 trillion of GDP is supposed to be created through AI. Okay, you're on week number one. All right, now that does not mean that we're just going to go up every day and it's going to be rosy. No. You're going to come back down. You're going to test levels. You're going to try to break out. You're going to fail again. You're going to reevaluate your life right on the trade. You're going to come up to levels you're not going to break. And then eventually you might push. And that's what you want to do. Okay. You have to understand the thesis. I cannot stress this enough in what's happening in the market right now, that people need to start understanding fundamental analysis. I'm not talking about PE. I'm talking about what is going to be the growth driver of the stock market for the next 3 to 5 years. And you're staring at it right now. You're staring at Nvidia. Okay, Nvidia 2023 is our Intel from 2000. Okay, it's really that simple. Only this is on a corporate level, and instead of billions, which was Intel, which was, by the way, worth 500 billion back then, 23 years ago. And people are saying this can't be worth $1 trillion 23 years later. Right? Just keep that in mind. Now, here you are, and we're breaking out. Now, what else does this mean? It means you're going to have periods of exuberance. Okay? This is Bollinger Band's third standard deviation. I showed you this on the SOXX. This is everybody all of a sudden has to get into AI, and then it dies down. And then what happens? We'll revert to some mean in here, and then we'll just sit there. That will provide an opportunity for us that know better, that want to take advantage of the pullback. Or you could sit on the sidelines and watch it go and talk about that the market surely has to take out a low. That crowd's been waiting for 9 months. And meanwhile, you have companies out there that are beating and exceeding earnings estimates, and it is a multi-trillion-dollar industry. A couple names. CRM came out with earnings, beat expectations, exceeded expectations, raised guidance. It's down about $10. I do want to go through this. Some of these have gotten ahead of themselves. We can clearly see that. I do not think this is one of them. Candidly, I thought this was a great quarter. AI had earnings. It was okay. It was not this blowout that they were talking about. They raised for last year. If I was short, I'd probably be wondering what my next catalyst is. You know, you could just say, oh, well, AI is not going to work, and we're years away and it's going to come back to 17. I mean, that is an argument, sure. But I don't know. I don't know why people are going to stay short. I'd watch this really carefully tomorrow. This is something I'd pay attention to a lot. You had OKTA come out with earnings. People did not like the guidance at all. Stocks down. So you're seeing things a little frothy, and Chewy had good earnings and people are excited about them. Now, I do want to address a couple things that I saw at the end of the day that I think can benefit you tomorrow that most people probably really weren't paying attention to. I know a lot of people in the Alpha Chasers community paid attention to this, and that kind of made me happy. So if you just want to take a look at this on a 5-minute chart, actually what we're going to do is I'm going to drop this to a minute at the end of the day. late in the day, you'll notice that all of a sudden out of nowhere, the volume started picking up. So volume started picking up crazy in the last 10 minutes. And it was really just a dump. For example, you can see this in Nvidia. Just look at the last 10 minutes of the market when this happened. When you're selling this indiscriminately and you had all day to sell and you're selling indiscriminately here, 9 times out of 10, that's a margin call. So I think that this volume was somebody protecting themselves. Now, if you take a look at Apple at the end of the day, same exact time, 350, just a massive dump. They had all day to sell. And when they came here, either they couldn't come to terms or come up with the money. They just sold. They didn't do it at 4 o'clock market on close. They just dumped at 350. This is pretty much a textbook sign that somebody had a margin call and this is what happened. Now, what I would do with this, I would go through the list of the top biggest 20 names and I'd come up with the ones that were most interesting, i.e. Nvidia, AMD was interesting, but Apple was more interesting, Google, and just look at this. I would watch these off the open. And if you don't see more selling right off the open and you see some kind of bounce, that would pretty much prove my thesis to some extent that this was just somebody that just had a call and they cleared them out at the end of the day and that's it. And this might present an opportunity in those 3 names. Have a good night, everybody.